Hello and welcome to our market alert video for today, which is March 1st, 2024. Unbelievable. January and February are already done. Time flies when you're having fun. I hope you're having a lot of fun. I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America, and I appreciate you watching this video. Our job, as we see it, is a very noble one. We have a noble obligation, and that is to create as many squippers as we possibly can. And if you're wondering what a squipper is, it's someone who's enjoying their second childhood without parental supervision. Squipper is the acronym for that. And so when a client of ours retires, we call them a squipper. And we want them to go out there all over the country and be squippering their little tails off. We want to be walking around and going, look, there's another squipper tail and another one. They've been squippering their tails off. They're all over the place. That's what we want. So if you're not a squipper, we'd like to help you to get there. And our website is rpoa.com. So let's talk about what happened this week. We got the data on inflation with the preferred measure that the Federal Reserve looks at, which is called the PCE deflator. Oh my gosh, what is that? It's a deflator. You don't want that, do you? Well, the PCE deflator is a measure of inflation that weights the consumer very heavily. And the reason why the Fed likes that number is because the consumer is 70% of our economy, and therefore they feel that maybe that's a better measure of where inflation is going. So the number came out this week, and it was a real big, giant ho-hum moment. It came in basically where everybody was expecting it to. There was no reaction in the markets to speak of. It was kind of like, yeah, okay. So, but however, having said that, the inflation number did come in a little lower, which means that the rate of inflation is continuing to decline. And that's a good thing. So therefore, what it means is that our view, which is that inflation will come down enough that the Fed at the earliest will lower interest rates in July, is still intact. Our fearless forecast is still there. Now, this is contrary to what apparently the market thinks, because last year even, they were saying, a lot of the big banks and a lot of the big financial institutions were all saying, by the end of this year of 2023, we're going to have 6 rate cuts or 3 rate cuts or whatever it may be. And we were saying, no way, it's not going to happen. And it didn't. And so this year it was like by March, we're going to have like rate cuts all over the place. Well, no, hasn't happened. And we don't think it's going to happen either. So now the talk is it's going to happen in May. We're going to get 6 rate cuts this year. No, we don't think so. We think the earliest is July. And when the Fed does cut rates, we think what they're going to do is they're going to cut those rates very carefully. So in other words, they'll do one, and then they'll wait and see what happens. Then they'll do another, and then they'll wait and see what happens. They're going to be very cautious. They do not want to repeat the mistake that Paul Volcker made back in the 80s. He was the Federal Reserve Chairman at that time. He lowered interest rates too soon. Inflation went back up again. They had to raise interest rates again, caused all kinds of havoc. Don't want that. So the Federal Reserve does not want to make that mistake. We think they're going to be very careful. So we think that in the second half of this year, interest rates will go down because inflation will have come down. But we only think maybe 3 cuts at the most. So we're a lot less optimistic, shall I say, than many on Wall Street are. Now, having said that, what does that mean to you and me? Let's bring this home and talk about what it means to us. Well, from an investment standpoint, if inflation's coming down, interest rates are coming down, then the cost of money goes down. The consumer has more money to spend if inflation is coming down. The cost of borrowing with credit cards and mortgages is lower. That's good. Consumer spends more money, and that will drive profits. And as you guys know, our view of the world is it doesn't matter what employment, what inflation, what anything's doing. What matters is profits. If a company's profits are going up, we think its stock price will go up. If profits are falling, its stock price will fall. It's all about profits. So going into the end of this year, the economy looks strong, the consumer looks strong, inflation's coming down, interest rates could possibly come down. If those things happen, that's very good for profits, very good for the stock market. That's why we are currently fully invested in our stock portfolios. Now, on the bond side, it also looks good. Why? Because as interest rates come down, the bonds have an inverse relationship to interest rates generally, so bonds should go up. We've just been through the worst bear market in bonds perhaps in history because the Fed raised interest rates so fast and so high. So therefore, we think that when they start lowering rates, we're going to have a historic rebound in the value of bonds, and a rally we've never seen the likes of before. So that's why we are currently fully invested in our bond portfolio as well. So it's looking like this is going to be a year, as I said last week, that's going to be kind of weird. Bonds and stocks may go in the same direction, which is not something that happens very often. So overall, things look good. Now, we believe that yes, growth is important, but protection of principal is even more important. So we don't want to plan for the best and hope the worst doesn't happen. We want to plan for the worst and hope the best happens. So therefore, even though our fearless forecast right now is rosy and it looks like stocks and bonds are going to do well, we still think it's so important that you have a protection strategy, that you have a strategy to protect your retirement. And we do. It's called Invest and Protect. It told us to sell in November of 2007, told us to stay out for all of 2008 during the credit crisis, told us to sell literally the day before the pandemic started. It told us to sell in April of 2022. And all of those instances, you know how much the market fell after that. So we want to help protect our clients' money so that they can have that second childhood without parental supervision. Now, we would like to help you too. So our website is rpoa.com. Thank you for watching this video. Share it with as many of your friends and family as you possibly can. We want to help everyone become financially secure if we can do that. So thanks for watching, and we'll talk soon.